Welcome to the Salty Investors, episode 17. How are you this week, Tim?
Yeah, pretty good. Yourself?
Oh, getting there, getting there. Just trying to get a comment. It's a new year. It takes a little time to get off the mark, but I think, yeah, I'm back. I'm back.
Yep. Oh, that's good.
Um, what's Tim's salt this week? What do you got for us?
Oh, these, rich people over in Europe, that decide to have a bit of a holiday and go to Davos, and
Mm.
thought they could tell everyone what to do again this year, same old crap that's going on there. And, I just, Jamie Dimon, perked up a little bit and said, we've got this war going on. Surely that
Mm.
should have a little bit of, you know, be a little bit important here, compared to the same old
Mm.
crap we keep going on about. The end of the world is pretty important if we get this wrong. But yeah, everyone's just going on with the same junk that they go on for every year. And so, I don't know.
Yeah.
What do you think?
Oh, well, I thought Davos became a farce many years ago when the celebs started showing up. So I was just going to ask you, who's the celebs this year? Do they have any? I
Oh,
did see Al Gore, who's kind of, he kind of, suppose he's a little bit of a celeb. Hasn't been a politician for a while. A very aging Al Gore. Jesus Christ, look like climate change is having more of an effect on his age than it is the actual planet.
uh, oh, he's still pretty wealthy, that guy. I think
Mm.
Al Gore's doing pretty good for himself out of all these funds and everything he's got running at the moment. But um, yeah, I haven't seen the celebrities. I don't know. Trying to keep,
Mm.
there's the BlackRock guys, telling everyone else what to do. Running trillions of dollars and all the
Well,
ESG stuff. Yeah,
isn't that the whole the purpose of these confabs is for our betters to tell us how to live?
yeah,
That's
yeah.
the whole purpose of it, isn't it?
Yeah,
To
and we
the
can't
the
afford
smart people get together. Yeah.
yeah, we can't afford, 12 eggs, but these
Mm.
guys have got time to go over and, spend time on the slopes over in,
Mm.
Davos, like
Ah,
inflation's out
that's
of
a good.
control, everything's out of
Yeah.
control, but oh well, at least someone's got some spare money here to throw around here to go to. What are
Yeah.
you salty about?
I'm salty about something that may be tangentially related to finance, but not really. Jacinda Ardern resigned as PM of New Zealand, and the gushing, obsequious fawning over her that she's so classy, she left at the top. If only we had more leaders like Jacinda. Some people have been crying because she left. They've been admitting on Twitter. It's very hard. I actually put out a tweet and asked people what her accomplishments were. That what I got back was she was kind. She had integrity. I mean, which is arguable. Not much in the actual in the way of actual accomplishments. So, like, did you actually do anything? I mean, one of the election promises she was elected on was to build 100,000 public housing,
Wow.
100,000 public houses. She built 1,300. So that's about 1.3% of what she said she did. So, like, she's not immune to global forces. New Zealand's got a problem with inflation. They got a
Yep.
problem with standard of cost of living, all of that, and people are dissatisfied. So people who say that Jacinda Ardern is leaving at the top of her game, she's leaving. She is a rat deserting a sinking ship. She knows she's not going to get elected at the next election,
Mhm.
and she's bailing before she's held accountable by the public. End of story.
Yep. Oh,
What do
well.
you reckon? Got anything to say about Jacinda?
Oh, you know, just platitudes, trying to please everybody and not
Mm.
achieve anything, for the average person over there. I think they're hurting pretty hard. So,
Mm.
especially after COVID and all that, and their inflation's out of control as well. Housing is a shambles.
Their
So,
Reserve Bank's actually been a lot more aggressive, haven't they?
yeah,
They're at 4.25, I think. Um, but yeah, so the things that matter to real people, and it goes back to your Davos salt, which is that the people who are out there deciding and telling people how they
mhm.
should live and what they should do are completely insulated from the things that affect ordinary people's lives.
Uh,
They don't. You could turn. You could end fossil fuels tomorrow, and Al Gore would still have a high standard of living. It's just probably 98% of the world wouldn't. That's the problem.
uh,
Yeah. And I'm sure Jacinda, though. I mean, she was a pretty much in line with the World Economic Forum on
Mhm.
all kinds of issues. So, I mean, there's a plum job waiting for her there somewhere, I'm
Yeah,
sure.
yeah. I'm sure she'll be doing all right. I don't think she's got too many worries about going down the supermarket and, you know,
No.
making ends meet
God,
here.
you think she goes down to the supermarket? I don't think so.
Uh,
uh, Not like us plebs. Um, let's move on, shall we? I came across a thread on Twitter by a guy that sort of specializes in the US housing market. So to recap, last year we've been talking about housing, that housing is going to be a bigger problem here in Australia. Um, because of the number of people who are exposed to floating rate mortgages rather than fixed. And in the United States, you've got the majority of people are on a 30-year
yeah.
fixed and in the last few years got them at really low rates. So then it's not really a problem. But of course, there is a problem in terms of if you want to sell your house or you have to sell your house, you're going to have to accept a lower price. Now, I just want to bring in a couple of charts and sort of say what's going on with the US housing market. A lot of people say you can't have a recession in the US if housing doesn't tank, because housing is such an important part of the economy. Don't know how true that is. But this is just the Goldman Sachs Housing Affordability Index. And you can see it's actually
Wow.
never been less affordable. So the lower you are on that index, it means that the less affordable housing is. And that just reflects, sharp rise in interest rates in such a short period of time. As I think we've said before, there are many theories in Australia about why house prices go up so much over the years. Is it investors? Is it incentives, other things? And no, I think it's pretty much we know the answer now. It's very cheap money. Then you can borrow a lot, borrowing capacity. So yeah, I think that's playing out in the United States.
Mhm.
This was KB Homes, pretty big home builder in the US. 68% of contracts were cancelled in their
Wow.
Q4. That's what they announced. 13% a year ago, as you can see, going back 5 years. So this is pre-COVID.
Mhm.
Cancellations ran around a quarter, 28%. So that's pretty big. And you would say, and with home builder earnings, what you got to keep in mind is that their earnings this year are pretty much based on contracts signed the previous year.
Okay.
So these cancellations here are not going to be reflected in the full year 2022 results. They're going to be reflected next year.
Okay.
Um, so that's something to keep in mind with home builders. So I'm trying to bring the purpose of talking about this is to bring it back to is home building stocks a good buy right now, or what? Sorry, I keep forgetting the name of that company that you brought up. That
NVR.
NVR. Yeah, I mean, what do they do again?
Well, they don't actually purchase land. So
Hmm.
one of the biggest risks in a recession is, if you purchase the land and the thing halves in value, you're stuck with a lot of assets that have to be
Yeah,
downgraded. But if you're
yeah,
just, you're not actually purchasing the land, you're just building the homes on a contract basis, and
mm,
they get cancelled, it doesn't hurt you as much. Your balance sheet
mm,
doesn't just fall away, and it's
yeah,
capital light as well. So you're investing in
mm,
things that can, compound a lot better than land.
yeah,
You're not getting,
yeah.
yeah.
And there was another stock that you talked about that does some kind of siding or cladding. Do you remember that one
Oh,
in the US?
no, not off the top of my
Yeah,
head, but yeah. But
no,
oh yeah, there's one of Buffett's ones, I think. Yeah.
yeah, yeah, yeah. But just there's going to be flow on effects. Yeah, as you know, we've mentioned on this, or I've mentioned on this podcast before. James Hardy last year we
Mhm.
reported when they downgraded their guidance, and I suspect there might be another downgrade in the future there,
Yeah.
uh, just based on what we're seeing.
So
Um,
these cancelled contracts, they're not
let's
really,
get
you know, inflation's sort of coming down. So you think building materials
the
should be
raw
coming down.
materials. Yeah,
So
yeah,
so that's not the problem here, obviously.
no, no,
So
no,
that's a bit scary when you think about that. It's like building material, because that was the problem before. Everyone's saying, oh, they're cancelling everything because of all these building materials, so they have to up the quotes over and
yeah,
over. So because I think they've got provisions in there, you know, the cost of goods goes up so much they can requote, and then people got a chance to cancel. But you know,
So it's probably a bit of both. I mean, it's probably is some of that, this year, but this is now Q4,
Yep.
and it's probably also the fact it's a lot more expensive to take out a mortgage and build a home. That's a combination of those things. So this one was just I'd never heard of this website before, Zonda. So quick move in inventory, which I didn't. I don't know what the definition of that is. Quick move in. So I guess it's ready to move in now.
Okay.
Right.
Yep.
So is up 200% from a year ago, and it's up 50% from pre-pandemic levels. I think that's the more important stat. So there's lots of houses out there. Again, it's all of this is just reflecting on it's going to be lower prices. You got more inventory, be lower prices. You have to shift it, which already exacerbates lower prices because of higher interest rates. So I think it's all just pointing to pressure on home builders. And so this tweet thread from where I got these few charts, it's actually probably 10 tweets in a row. And he said, so where are the home builders? And if you have a look at someone like
go ahead. Go ahead.
Throw that one in.
Yeah. Go ahead.
So this is D.R Horton. D.R Horton's stock price is near all-time highs. I mean, it's not too far off. It's about $95 a share. And I just put that up there myself. It's trading on a PE of 5.8 times.
It looks cheap.
And so this is your classic value trap. This is the old Tim Lester would just love this.
I'm sure it's got a dividend as well, just to entice me in. So.
It does. Actually, yeah. I did have another chart that had the dividends along the bottom there, but they pay regular dividends. So I just thinking like, again, that PE contains earnings from a year in which contracts were signed the previous year, houses were built, and if you think that D.H. Horton is going to suffer, his cancellation rate is up, that PE is probably not sustainable because it represents peak cycle earnings. That's what it represents. You got to remember the cyclical nature of these things, and that same sort of mindset when you see resource companies like when you're trading on 5 PEs, it's probably the time to sell them because that means it's peak cycle earnings.
But look at the rally there. Like that is insane. That rally,
like you can rally, isn't it? Yeah,
that's from 67 to 94. Wow, that's a huge rally. Going into higher interest rates. Oh,
yeah. Well, actually, I mean that moved down that took it down to just to touch under 60 there briefly.
Okay.
If you did this one,
yeah.
So it's up, more than 50% since late last year.
So,
and just go ahead.
I had a quick look at this chart. Back in 2005, that's when it rallied beforehand, but then, it was crashing a lot before 2007 there.
But you got to remember that housing was already coming off in 2006. So housing starts, the whole lot, that was all coming. See, that time period of 2005, 2006, that's when Peter Schiff, this is how he became famous, was going on financial shows and saying things like the market's going to crash, blah, blah, blah. And everybody at the time was saying it's going to be fine. Maybe there'll be a correction of 5 or 10%. And everything else. And that's what made him famous, because then they went back and got the Schiff clips from 2005, 2006. And, he became sort of a legend, and then predicted that gold would go to $10,000, which it never has in the last 12 years. But the point is, sales were already coming off, sort of 2006-ish, early 2006. And so that precedes.
But then, the GFC happened here, and it didn't actually correct that much. Then, from after that, because the market was already forward looking there, and a little bit. So
but that's the thing, isn't it? Because at the time, when you it's the same thing when you look back at, say, take up of internet. Back in 2000 when we had the tech wreck, you see this little downturn. Like right now, it's an imperceptible blip in
Hmm.
a pretty much exponential rise.
Yep.
But at the time, it looks like a big dip, right? And that's what, yeah, I think. I mean, the housing correction in the US in 2008 was huge, but the further away you get from it, the smaller it seems,
Yeah,
and
yeah,
people forget. Yeah.
yeah.
I just thought that was interesting. I don't know. I mean, I could be completely wrong. D.H. Horton's going to sail through, and the stock price is going to be $150 next year. I don't know,
Mm,
but worth considering if you think home builders are cheap. I think.
yeah,
Yeah. All right, that's enough of that. Did you want to go back to
yeah,
that
yeah, yeah.
previous chart first? Yeah. So this is. Well, why don't you take us through it?
Well, this is Grantham again, trying to scare
Yep.
the hell out of everybody. Um, like you look at this and you're just like, wow, everything is expensive. You know,
Yeah.
what sort of PE1 stuff have you got in your portfolio here that is cheap? Everything's expensive in this quartile. I,
What's shallow value? What does that mean?
well, all I could
Is
take,
that just means it's value stocks that aren't particularly cheap? That's it.
yeah, yeah.
Is that what
So,
it
but it
means?
must be
Yeah.
steep because it's comprised here of, price to sales, price to profit, price to book. So there is
Mm.
some, PE ones and threes and fives, as you can see from this thing that you just showed us. Um,
Yeah.
yeah, like wow. I don't know if I could actually go into any of these, 1 and 3 PE type stocks. Like, it just scares the hell
Mm.
out of me. Some of the miners and things like that,
Yeah.
gas and stuff like that. Yes, maybe I'll be more keen in that area. Energy, I think, has still got a little bit of legs, but I just don't know what I could do in here. Like, that's all. What do you got any thoughts? What you could go into deep, deep value? Like,
Oh, yeah. Deep values. Yeah, that scares me.
mm,
Because like you say, it's usually something that's on the nose. But like last week we did discuss retail. I mean, in
yeah,
retail stocks, some of those discretionary retailers are like actually from last week. I think Adairs is up another 10%.
okay,
Um,
yeah,
Something ridiculous or
nice,
close to it.
yeah,
But I think, yeah, like I said, I mean, I like retail if you can get it at the right point in the cycle.
hmm
So there's things I'd look at there. Not everything though. I mean, I'm not say, hey, buy retail. No, it's got to be you've got to do your bottom up work on
yeah,
individual companies. So yeah.
mhm, yep, yeah, just another markets overvalued type graph.
Mm.
I'm just because
Yeah.
you get itchy now. You get itchy thinking, oh, should I be diving in a little bit here? That's all.
Yeah.
So
Yeah. Well, there's that research affiliates piece earlier in the week going on about the folly of using forward earnings
oh yeah, that was good.
to. Yeah, I mean that's John Hussman's been going on about that for about 20 years. Don't use forward earnings, yeah, and don't use operating earnings, because operating earnings is just earnings minus management mistakes, basically,
Yeah,
that they don't we yeah
one-offs that will never happen, and
yeah
yeah,
one-offs that
exclude all
happen
that.
every
Yeah,
year.
yeah, yeah, yeah,
Yeah,
yeah. But all the
yeah.
good stuff, we'll count that. Yeah, that's a one-off that we need. To count boost those earnings.
Mm.
So I don't know.
Well, that's why I think they changed in Australia. We used to call them extraordinary items, and you can't keep calling this the same thing every year extraordinary, because then it's a contradiction in terms.
Mm.
Uh,
Yep,
yeah, the categories as
yep.
usual. Um, let's move on to RHI. You want to tell us about Robert Half?
Yeah. So I'm in this, trying to not be a smart ass, and Howard Marks put in this thing, a new memo, and he's been talking about stuff again, and saying, you know, credit's coming back and in a bit of a hard way here, and everyone's starting to look at balance sheets again.
Mm,
And he's sort of saying, when something gets into stress, you got to see, is it a good company, and just the balance sheet's taking a bit of a hammering here. Um,
mm,
and so I've got this, throwing out the baby water talk type portfolio type thing, the cars,
yeah.
housing. that type of thing that will just get burnt to the ground here if we do get a recession called.
Yep.
And this one obviously does because it's related to employment. But as you can see, the numbers, it comes back super strong, and it's been going for 1948 here.
Yeah.
So they find high-end people in companies, and I don't think that's going to get changed because we've got electric cars or blah blah blah. We've got robots. Every high-end jobs, finding high-end people for high-end jobs is still going to be in demand.
Yep.
So, but you're going to have to handle a couple of years worth of pain here, where it's just going to be the balance sheet is just going to get obliterated. And so I'm trying to find these things because I want a little bit more instead of trying to be conservative. I want a bit of something that's going to pop out. If we do get a strong recovery, because they turn on the printers, and these things are going to V-shape out of here. So if you look at these return on equity and invested capital, they're just insane.
Yeah, they're good, very good. 40s.
You look at the price to free cash flow. You're paying 13, so and you're getting a dividend. And look at the shares outstanding here.
Yep.
They're buying them back.
So they're buying back. Yeah.
Yep. Okay. So and you got your gross margins. They're in the 40s. But operating margin. It's not super high, but operating margin. You're in the teens. It does obviously get burnt here a little bit when things go bad. I put the balance sheet on the next slide. Because I know you've been hassling me about, I've got to look at debt, Tim.
Yeah.
I haven't looked at that for freaking 10 years. What do you mean, debt? The book value per share, remember that old metric? That one?
Yeah, that one went out of favor, didn't it? Jesus.
That'll come back in fashion, I'm pretty sure, somewhere along the line here. And the current liabilities, definitely under control here. They're going to get out of shape, but you can see.
But they've brought down their debt a lot. I mean, they had over $1 billion by the looks of that, and they've brought it down to $265 million. Over the last sort of 6 years or so.
So you can handle the balance sheet's going to get loaded up here a little bit, with a bit more debt. Hit a recession here because I've got all the staff, and they're not going to be able to cut enough quickly to handle that. But it's one of these ones, I'm trying to, grab something a little bit more exciting. Can I handle a little bit more pain and get a bit more upside on the way out? So
well, it's always good to see, total equity growing whilst you're reducing the number of shares. So your equity is not growing because you're just pumping out more executive compensation in the form of shares. You're actually buying them back, but your equity is going up. It means the company's worth more. It's just a very simple observation.
Yeah, this one's totally under the radar. No one talks about it. I saw some guy mention it on Twitter, and everything I look at Twitter, I'm like, just looks like junk. And then I'll see this, I'm like, wow, this is really something that I really could get into, especially because I can see the pain that's going to come with this, and the market's already correcting it. It's already discounting it, and I'm thinking, wow, you put another 30% on this, and then you've actually got some balls to hold through here, for a couple of years. You're going to get a very nice decade on the other side of this.
What are their earnings been like? Did we have EPS on the other side of this or not? We didn't.
No, this is I just did straight metrics.
Yeah, that's all right. I mean, I was just wondering, are they the sort of plotting we increase revenue and profits by sort of 5 or 6% a year? That sort of
Nothing,
which I increasingly
you never pick it up.
But so that used to be, to me, I'd go, oh, that's kind of boring. But to me now, that's become more attractive, and something that can. I mean, did you ever look back to say 2008 and see how they fared?
Yeah, but the thing, they put that in the annual reports. They put all that revenue and going way back, like decades,
right.
And you can see them in the GFC just getting smashed, the revenue and everything. But they're putting it in the reports, and so that shows. I'm like, wow, integrity. Normally you just get people, oh, we'll just show the last 5 years, everything's been rosy, but
Did they make money during the GFC, or did they
I
lose
didn't.
money, or didn't?
Everything went backwards. Like it really,
Yeah.
like net profits were just, negative. Everything, but they're showing all
Oh,
this. They're
mm,
educating their investors that they're not trying to hoodwink them to say, oh, everything's going to be rosy forever here.
mm.
That so they're getting the right type of investors on board. So I might not get a correction because they've got the right type of investors.
It's in strong hands. Yeah.
Yeah, yeah,
Yeah.
already, and it's only going to be the ETFs and the index funds that could possibly sell it off. All the big institutional holders that need to.
Yeah.
Um, so yeah, it's got the right type of people that you want holding. Berkshire Hathaway, just doesn't sell off that hard, and you know.
No.
So
Yeah.
I don't know. Might be delusional thinking here, but I'm just trying to add a few more things to my list here.
Oh, that's a good one. That's this is going in my watch list. So I think it's worth looking at. Is it? Are we at the end
Yeah, yeah,
this week?
that's it.
Go
Yep.
through. Oh, that's it. Oh, all right. Well, that's a good one, Tim. Thanks for bringing that one up. And we will be back next week with more wonderful ideas and commentary. So from us, we'll see you next week.